Well, let's also look at one that's been completely knocked out, and that is Delhivery. Clearly, the company hasn't delivered according to investor expectations in the fourth quarter. Stocks down almost 10%. And this after a very lackluster performance. Delhivery anyway was nowhere close to the kind of returns that a lot of other mid-caps were giving. And, actually, let's ask Mangalam what the issues are. Mangalam, one thing I noticed is that the loss still continues at the bottom line level, right? What are the other key internals that you looked at?
Well, if you look at Delhivery's numbers, it was a seasonally weak quarter. The fourth quarter, not typically the best for e-commerce deliveries, etc., especially coming off the third quarter, which has the festive season. So if you just take a look at, their overall performance, they still managed double-digit growth, and that's because of their part truckload business. And as a result of which, on an operating leverage basis, they saw an EBITDA growth from around 13 crore. The EBITDA jumped all the way to 45 crores. The company continues to report a net loss largely because of depreciation and Q-on-Q weaknesses, of course, on account of seasonality, like I said. Revenue growth of 12%, 2075 crores, and that because of operating leverage meant an EBITDA jump all the way from 13.5 crores to 46 crores. Of course, this was a big decline quarter on quarter, and the company reported a net profit in the third quarter. But remember, the third quarter is the strongest quarter for Delhivery anyway. The net loss came in at around 68 crores. This was a lot lower than what we saw same time last year. The problem point for the company was express parcel business. This typically tracks the growth of the e-commerce revenue in the country, and that grew just about 3% with a volume decline of about 2%. And that is an important main driver for the company in terms of growth going forward, because the largest component of the revenue, which is why the street did not like that. The PTL freight business has actually done extremely well for them, a 27% growth out there with volume growth of 21% as well. And then you had the truckload business, which grew around 59%. Supply chain as well saw a revenue growth of around 25%. The company said they've completed a large portion of their planned long-term capital investments, and they've achieved material working capital improvements. So the big trigger for Delhivery going forward is a pickup in e-commerce deliveries, and secondly, their operating leverage coming back once again. They're also looking to reduce their capex as a proportion of sales by a few hundred basis points, and that would impact their margins going forward as well. But the trigger on the obverse side is the big stake that Masayoshi Son is sitting with. So SoftBank, looking to sell its stake in Delhivery, keeps a lid on the gains that we see in Delhivery as well. Additionally, and this was an interesting development that took place, that Sandeep Barasia resigned as Chief Business Officer due to personal reasons. So let's see how much of that is weighing on these numbers. These numbers were weak largely because of the e-commerce vertical, but internals of the company, not particularly bad. In fact, they're only improving.
Okay, take your point on board, Mangalam. Thanks very much. But yeah, as you highlight, I think people can still live with the continuing losses because that's depreciation. But this segment that Mangalam pointed out, express parcel revenue, that is the largest segment, contributing to over 1,200 crores of revenue in Q4 for them. There, the volumes have actually declined by 2%. So that seems to be the biggest pain point that the market is not too happy with. Deepan, hi, good afternoon.